I think it will say. Well, good morning, everyone. I'm Andrew Dacres, Chief Executive of West London Business, and on Osome's live stream today, I'm delighted to be joined by Taimur, who is Senior Accountant at Osome, and we're going to be unpacking over the next 30 minutes the vast range of different finance options that are out there for your business. And I know from my travels zigzagging across the west of our capital over the past year, just the extent to which finance is, of course, always front and fore of mind for our business leader community. So great to have you with us this morning, Taimur, and to be doing this joint live webcast. I'm hoping that you've got a strong cup of coffee. I've got mine here, and I'll be tucking into it as we go. I think I've got some hobnobs as well. You'll be glad to know that the coffee beans are roasted in West London by one of our West London Business Award winners, the Artisan Coffee School, who've got a number of outlets across the west of the capital. And my hobnobs probably made in Park Royal, not very far from us too. So I hope you're well stoked up, Taimur, for the 30 minutes ahead. I think you're going to kick off with a bit of background for us on Osome, and just to give us a flavour of the business, because I think you're in the world of accounting, you're pretty unique in your approach. And then you're going to get stuck into the topic of the morning of financing. And as we go, I'm hoping that we're going to have some questions coming in on the live feed. But as always, I've got a few questions up my sleeve that I'll be chucking your way, Taimur, as we go. So over to you to tell us more.
Perfect. Thank you, Andrew, for the introduction, and thank you for arranging this webinar. Again, my name is Taimur. I am one of the senior accountants here at Osome UK. Osome started as an idea of with a mission statement of easing entrepreneurs, especially on small and medium-sized businesses, and the ease is coming through the source of technology and the AI. And the point is to reduce the admin, the bookkeeping, and accounting side of things for you, so you as a business owner can focus on making those business decisions based on the information needed. Look, the field of accounting itself and bookkeeping is changing. Before, it was just a mean to get your books completed, be more compliant, and be tax efficient. Now books are normally used to make sound business decisions through management reporting and analytical tools. So bookkeeping itself has become a great analytical tool to be used in-house and judge how your business is doing, how your vision is doing. And Osome's place here is to bring that in live on a real-time information basis to help you make those business decisions. And we have done that with a great tech team, creating apps with the ease of use, and providing your accountants in a very informal chat system. Rather than booking up appointments, you get accountant and their consultation through ease of chat. And then
do I remember, Taimur, that at West London Business, like lots of small businesses, we use the Xero software tool. Does your the nifty kind of software that you've been developing to help your clients talk to Xero?
Yes, so all the technology we work is based on Xero. So for example, if you're selling online, your Amazon, eBay, all of that information, we are the bridge between taking that information from those platforms and bringing it to Xero. And again, on the purchase side as well, our app itself connects to Xero. So whenever you take a picture of your invoice or send it to our app, it goes directly to your Xero account.
Cool. So that's given us a good flavour of Osome and your approach, and how it's a bit different to other financial firms and accounting firms out there. Our hot topic this morning, of course, financing your business, and I think you've got some reflections to share with us to get the conversation started.
Yes, let me start with sharing my screen. So can you see my screen?
Not quite yet. Hopefully imminently.
Okay, I'm ready with my presentation. So you should be able to see my screen.
I can't. I'm
Give me a second. Let me see.
hoping that that others can.
Bear with me.
It's that share icon at the bottom of the
Yes.
the
So
screen is
I
the
am sharing my
critical.
screen again. Let's give it a
critical link.
try. Okay. How about now?
Aha! This is looking more promising.
Good stuff. All right.
Magic.
So again, this is the presentation, financing your business, top takes, and some recommendation. And then, as we said, this will be a live Q&A with Andrews and anyone in the chat. So the agenda for today, we already discussed who we are and what we do. We will talk a little bit about financing your business as an introduction, how budgeting, forecasting, and costing plays a big role on it, types of financing, and then the big difference between loaning and investing in your company, and then a little bit of a more different financing topics, and how accounting and tax plays in the part of this whole financing role. So to start with, a little introduction of myself. I've been in accountancy and finance business for almost 6 years. I'm an ACC finalist and manage a portfolio of over 200 clients at Osome. So I go through starting a business to their maturity stage, and I see how they go through the whole journey of their business, and I can recommend them some good tips to continue towards the success journey. So let's quickly start. Why you should focus on financing as a starting point of your business. Cash is one of the main elements. You need enough to start, and then once your business has started and it's out of your growth period at maturity level, the inflow will support the outflows. But to get to that stage, you need cash, and cash is king. The most common understanding is cash is the lifeblood. So you need that cash and to bring your visions into reality. It helps you with the competition. If you have cash, so for example, if you're buying things in bulk, you will get more decent pricing compared to if you don't have that cash and you're buying it on credit terms, you'll probably not get those good pricing. So it helps you in competition on many different elements. It helps you to penetrate the market and be on top of your competition. Business relations are really affected by cash. If you have good cash flow, normally in the realm of small and medium-sized businesses, we deal with the small businesses, and for them as well, cash is key. And if we keep the cash running, we keep the relationship good. But if we fall behind on payments, we affect those small businesses as well, which can damage your long-term relationships. And the biggest part is that it helps you plan your future. If you have the cash, you know how much you can and how much you cannot. So, for example, Q4 is here. They're going to be big calendar events, Christmas, Boxing Day, Halloween. If you have that cash, you can plan how much you can avail of these big events, and not over or underspend on your plannings. So knowing why you need cash and why you should be looking at financing, we need to know how much you actually need, and what options are available to you. And for that, the best four options for you on accounting terms are budgeting, forecasting, costing, and expense analysis. You need to do these four at the start of your business, or even the start of any project, to understand and to realize where you are and where you want to be, and how much financing you need for those business ideas or those new projects that you want to dive into. Now, start with budgeting and forecasting. It's a very common practice for businesses to do, but it's also seen that a lot of businesses do not focus on this, especially the startups. They normally just dive into it, and then they think that they understand, through their vision and through their understanding of the segment. But budgeting actually helps you put everything in perspective. It helps you ensure that you're not spending the money you don't have, and how much you need and how much you should be borrowing. It helps you plan the activities of your business and focus on short term and long term. So when you're budgeting for, let's say, a year, you can focus on what you will be achieving in the next 3 months and what you will achieve in next whole year, and plan your way around it and plan your cash based on that. The best one about budgeting is that it raises alarms before it's too late. So if you budget, for example, let's say a rental cost, and you're paying £3,000 on 6-month basis. if you end up paying more, then you will know on spot that you're not this cost is not relevant to your plans, so you then need to think of finding something else. But if you don't have budget in place, you will end up spending money without control, and that's where this helps by raising those alarms beforehand. And again, it helps you control all of your cost. But these are internal elements. For external purposes, people who do budgets and forecast, fundraisers, investors, and loan lenders always appreciate them before the people who don't do budgeting. If you go to investors and you have your current year's projections and your budget in front of them, and then you have a logic on how you're achieving all of that, a fundraiser will be a lot more at ease to give you that funds rather than people who don't. And then again, it helps you analyze your whole business itself. So I have a small example here that can I've made a template for our existing clients, and it's free for you guys to take it as well. This is a small example for budget itself. So it goes from January to December and then total at the end. And I took two different types of products: sales of a product itself or sales of a service. And you can see that let's say if you're just starting for the first 2 months, you might not have any sales, but you will have expenses, and you can end up making a loss of up to £7,000. And if you go along it, you can only see that or not only up until April that you will make your first profit, which might not be enough. So then you need to project it for the whole year, and then at the end of the year you might be making a net profit of 23,000 based on a sales of 66,000. But again, these are just random numbers based on what I've seen of what small businesses do. If you plug in your numbers here, it will tell you exactly what your vision will look like into numbers. And then again, these are the elements where I mentioned that it can help you control. So your fixed cost and your variable cost are the most important one that you need to see how they pan out when you actually doing the activities in your business. And if they are not aligned with your vision, then obviously you need to make certain changes to control that. But budget is the most common practice, but it's a very accounting term. The other element of this is cash flow. And cash flow works in a completely different way to what profit works and how sales work. Profit and sale gives you the whole idea of what your business is achieving, where cash flow looks at the real aspects of your movement of the cash. So with the same figures, but exchange of cash in a different way, you will see that although you were making £7,000 worth of loss in the first month, but actual cash loss would be somewhere around 15,000. So it's very important for you to have a cash flow under your belt as well, so that you know exactly how your cash is moving. And once you have this, you can then plan your finances and then look at your borrowings and further investment.
And can I invite you, Taimur, just to amplify on that a bit, because a few folk that are perhaps looking at this sort of thing for the first time may be a bit surprised at that sudden, much larger sort of loss figure that you're showing in January when you take the sort of cash-based view. So what's happened differently on the sort of, and is happening differently on the sort of income and expenditure side to drive that sort of larger cash-based loss?
Sure. So if you look at your P&L, profit and loss, the way it normally works is it distributes your expending and receiving on to monthly basis throughout a period to show how much you actually made or lost in a specific period. So a great example of this is you made sales, and these are the sales figures. But when you actually spend the money, the way cost of goods sold work is, regardless of how much inventory you have bought, you only put on cost of goods sold the things that you have sold to reflect the sales of the expenses you have made. But when you go to the cash basis, obviously you will have different cash settlement with your suppliers. So for inventory on the same month, you might be buying bulk, and you will be spending a lot of money. So all the money upfront. So the example I mentioned here is on the second month. Let's say you bought the inventory for £11,000. That has a direct effect on your cash flow, and it shows more cash deficit rather than the actual cost of goods. Again,
so fundamentally, this really kind of comes down to timing. That on the cost side, it may well be that you have to pay certain suppliers in advance, perhaps in a worst case scenario. And on the income side, you might raise an invoice, so it kind of goes through your P&L, in March, but then actually, if you're lucky, your customer might pay you within 30 days, but it could drag out for longer. So you've kind of got the sort of cash being strained in both directions.
Exactly, and that's and the accounting term used for this is accrual basis, right? So anything, and it all, as you said, depends on timing. So on profit and loss accounting and tax purposes, we use accruals, accrual-based accounting, which is that you record an expense or sales at the point of obligation, that you're obligated to either pay this or you're obligated to receive it. Whereas on a cash basis, it actually works on physical cash transfers. So as you gave an example of a sale that you don't receive it up until a month, but on this day when you sign the contract, you're now obligated to provide that service and receive that money from your client. You will record sales on that day based on accounting, but you will probably
So critical that you plan your cash position around that sort of cash forecasting exercise, or you're just you're going to put yourself at risk of running out of cash in the bank.
Exactly, and because a lot of people focus on profit and loss because that's the most common reporting system, they don't focus on cash flow, and you need that cash flow statement to understand how physically cash flow is exchanging your hands in your business, so you can plan that better and then look at financing options for you to maintain that. So just last point on this is, as you can see with the cash flow, you might not actually start getting the cash inflows or the balance of it up until the month August. Again, these are just random examples, but this is how normally businesses work, and this is what you should focus on when you're planning your business. So coming back to the presentation, so that's budgeting, forecasting, and costing, and how it can help you in controlling your business. Now, types of financing. So once you know why you need financing and how you can measure how much you need financing, there are two different main types of financing. One is loan, and loan could be from yourself, from family members, or from outside external individuals. The way loan works is that the only tax implication for a loan is interest, but the balance that you're getting and receiving, that is just a balance sheet item. So you do not have any further tax implications on it or accounting implications. It's just a money in and money out. On your balance sheet, it will show how much you owe and how much you still need to pay back. Whereas investment side of things, it works in a way that you give a part of your business to someone for exchanging money with you, and that can work in dividends, in the shares of dividends going out to them, or if you have invested yourself, you will be getting dividends out of the business. So the big difference between two is a loan can go into your business and come out without any further tax implications, whereas investment, when it goes in, it takes a part of your business. Plus, when you take the money out comes in form of dividends or a taxable income. So considering those two in mind, let's look at the pros and cons in more details. So loaning a company, there's no tax implication except the interest element. But if you are loaning from your personal money into the business, then and you're doing it on interest-free basis, then there's no tax implication at all. Loaning the company is a lot more simpler and straightforward in terms of paperwork compared to investment. And on bankruptcy, for whatever reason, if your idea did not go as planned and you end up bankrupting the limited company, the creditors are higher on the list to getting the money back, but the investors are the last one. So those are some benefits of loaning the company when you're doing it yourself. Some drawbacks of it is that if you have loaned your company a lot, let's say you loaned and £20,000 and on your balance sheet shows £20,000 outstanding from company to you, external investors do not like this because they want to see you risking your money to the company as well, so that you believe in your idea and they would want to see that you trust in your idea enough to risk your money through investment. So if you're loaning, just be mindful that when you're going for outside investors, their attitude would be slightly different to it.
I suppose, is it fair to say that a loan clearly isn't without any risk? There's some risk. It's just not quite the same dynamic as making it an investment. Is that fair reading?
That's completely agreeable, because if you go bankrupt and you do not have any funds at all, then you lose out that money as well. And also you're spending your personal money, you're loaning your personal money to the company, which obviously entails a big risk as well.
Indeed, and if it's interest free, then again you're not taking interest on that loan on capital that you could be putting elsewhere.
You could be putting elsewhere. You're losing on opportunity cost basically. Again, this shows a debt on your balance sheet, which could not be attractive to other lenders. So key consideration as a starting point, it might be a good idea to start with lending to your own business. But once your business has enough revenue, you should be able to pay yourself back and bring the balance sheet to neutral without any further consequences. So how about if you want to invest in your own company? So the more you invest, the more shares and the ownership you get in the business. Dividends that you receive for the numbers of shares are the most tax efficient way to get the funds back. It's currently charged at 7.5%. However, the number is changing next year based on the new budgets. And there's a 1.25% increase on that. So just be mindful of that. External lenders tend to prefer businesses where owners have invested in their own business themselves. The drawback for it is obviously it's less risky. It's riskier because shareholders are the last in priority after bankruptcy. Key consideration: if you're planning to grow your business and would like others to get involved, then investing in shares is the better option, as it shows that you believe and trust in your ideas and attract other people who will take risk for your business. So, types of financing. So the first one is friends and family. This option is more suitable for businesses that needs initial support to prove the concept of their idea and that it can be successful, and to the point where they can then seek funding. So initially, if you have just starting, you might not get that attraction from external investors. So maybe start with friends and family, and then see how it goes. The treatment of loan from friends and family works in the exact same way that we just discussed if you're personally loaning the company. Just remember that you do have an option to charge interest to your company. It's not that you always have to do interest free. But when you do charge, your company can record that as expense, but you personally will have to pay tax on the interest that you're receiving from your company. Remember, your company is a complete separate legal entity to you. So whatever dealings you have will be treated as you would treat with any other company. But the money that you receive from your friends and family can also be treated as loan or investment. It basically, you need to decide how you want to treat that money. Do you want to give a part of your company to them or just treat it as loans? Another one is short-term borrowing.
I'm going to ask you to pause there, Taimur, because I know you don't have any pros and cons slide on friends and family sort of in investing, and I suppose it strikes me that if all goes very well in terms of business development, then I'm sure family relations and will equally be strong. But if things don't took a turn for the worse, potentially quite difficult. Does that make folk nervous in your experience of going down the friends and family route?
Well, I can. My family has a background of businesses as well, and there has been instances where family got involved, and business went really well, and some instances business didn't go well. So it does affect your personal relationship. I completely agree with you. But again, when you are asking those fellow friends to invest, I think best is to tell them the risk involved in this, and you're pitching them as well. So the way you would pitch an external investor, you would pitch it to your family as well. And when you do that, they should be okay with the consequences as well. But if they're just lending you on good faith, then yes, you need to make sure that you're doing the right thing for them.
Yeah, and there's got to be due diligence on both sides, as you say.
Exactly. Yeah. Right. So short-term borrowing, it's the most common one on small businesses because it helps them with the cash surplus. So I used to work for a company where VAT and salary used to be a big cash outflow, and our invoices used to come 60 days later. So we had a big gap between when we received the money and when we supposed to get the money out. So we used to use a lot of short-term loans, and you can actually nowadays there's so many financing options available that you can get loan for specifically paying your VAT or specifically paying your staff. and then interest is quite high on them, but there are options out there. So you can use your overdraft limits. If you are doing really good and your business account has a good credit history, you can get good overdraft. One of the companies I used to work, they had an overdraft for £200,000, and we used to be always in overdraft because of the cash flow. But there is an option there. Interest is quite high. It's normally paid on each day basis, and surpassing your overdraft limit leads to bank charging a lot more higher interest rate and probably less credit history, and damaging your credit history and relationship with them as well. So short-term loans can be a great tool, but there are consequences to it which needs to be looked at before actually jumping into it.
And generally, in your experience, are businesses that are going to high street banks for that short-term borrowing, and if so, is there a lot of information that you're having to provide to the banks to support their due diligence on the loan?
Well, I've seen a different trend. For your overdraft, you will definitely go to your commercial banks, but for short-term loans, like as I said, paying your VAT off or paying salaries off, it normally tends to be a different supplier, or mainly online, not very known lenders, because their interest rate are more favorable. So in the companies I've worked before, all of the loans they had were from non-commercial basis. But if you are on commercial basis, the best thing is that you normally get a management accountant for your business, and they can talk to you and exactly go through your business. But in terms of getting those loans, there's a lot of paperwork involved. You need to show them your budgets. You need to show them your forecast for the next few months. You need to convince them that whatever you're borrowing, you will be able to pay that back. And normally you show that through the invoices you've issued and future cash flow forecast.
And that's the same whether it's a high street bank or one of the online lenders you mentioned.
Yes, I've seen a trend that online lenders are slightly more lenient. They have a higher risk threshold compared to commercial banks, but due diligence is almost the same for both of them. And there are options for cash borrowings as well, but all of these terms for short-term borrowing. Remember, short-term borrowing can be very expensive in terms of interest. So you should only be using this if you really need to get through your current stage. Some other parts on short term, again, you can get proper loans out as well. But one of the best things I've seen is invoice financing. And the way it works is that you actually get in partnership with lenders who will pay you your invoice upfront and wait for your customer to pay you. So the way that happens is you sell your invoices to them, and they will pay you the money for those invoices, deducting their commission, and then they will chase the customers on due date to get that money, and they keep that money. So in an essence, for small fees, you get your money upfront without further risking it. But again, it reduces your sales a little bit, but at least you're getting the cash upfront. But that option is available for you in your small business.
But perhaps an area that's got a bit of a bad name recently with the collapse of Grensill, which obviously was a business to some extent built around invoice financing, as I understand it.
Yes, I think I did read about that, but I don't have a great understanding of it. But yes, invoice financing it can work around those ways. Yeah.
And I suppose critical in terms of the lender and this I think is where Grensill somewhat fell down. Actually do due diligence on your invoices and make sure that those funds, or a majority of them, are recoverable.
Yes, what they do is they will look at the historic transactions of your business, see how each suppliers of yours have been paying you previously, like the credit terms. They use things like receivable days formula to check how much days it actually takes you to get your money after issuing an invoice, and then see all the invoices you have raised and their prospective as well. So they will do their due diligence before they actually give you the option to start working with them. But once you have passed that stage, every single invoice you raise in future can work on these spaces. But again, remember, this could be expensive because they charge interest and fees on all of these options. Crowdfunding, it's another way of raising finances, but again, this is now coming away from loans and more into investment. Now we've talked about how you can personally invest your business, how your friends can help you invest on your business. The third option is crowdfunding, where you go to public to raise finances. So if you're a limited company, you can go to public. You can make the ownership of your company public in return for investment from the public. It generates a great pool of initial funds. The more people you reach, the more publicity also you get for your business, because the more people are getting aware of your business. However, and also it dilutes the risk among the shareholders, because whoever is buying your shares, the risk of ownership is distributed among all of the shareholders, not on you only. But the drawback of it is, when you're diluting risk, you're also giving away a big chunk of ownership of your business as well. So it's a long and hard process that requires a lot of publicity as well. So it's not just as simple as going out there and registering your company to public. You have to do a lot of publicity, and you have to make sure that you're okay with sharing your business with the mass, basically. Again, this will only work if your business has a great growth potential and will attract the general public. It's very competitive out there. The share market gets really competitive, so you need to have a really great idea and a history to show that why a public should buy your shares and pay you good money for your shares. Angel investors, again, it's the same concept as crowdfunding, but rather than going to public, you actually go to investors who are looking into buying a small portion of small businesses, but pooling in a lot of money. So these are high net worth individuals who provide finance backing for small startups, entrepreneurs, and typically exchange for an ownership of equity. Um, and they're incentivized for this by governments. The more they invest in small businesses, the more tax efficiency they get, and the more tax relief they get. So for them, it's kind of a win-win situation. But for you, it's a good opportunity to get more cash, and plus um, um, big and highly investors involvement into your business, who can probably guide you a little bit, but put their money into it. The only problem is that unless you have a good network of your own, you might need to hire an agent to introduce you to a lot of investors. And there are a lot of agents out there who can introduce you to these angel investors. Government also helps to pull in some money. So there's a startup loan, it's called British Bank scheme, mainly aimed for individuals who have been able to secure funding, who have not been able to secure funding from anywhere else, but have a great idea that has a good potential. You can borrow up to £25,000 for 12 months with a mentoring session from the government as well. You get fixed rates for 5 years with a repayment plan, and no fees for arranging the loan itself. And you can even use this loan to buy existing business, as long as you can show them that the idea is great, and the only thing that's holding you back is the funds. So again, please tap into those government schemes that are available out there, see how they can work for you and if they can benefit you. So how does this all work in accountancy and tax dependencies? So from accounting perspective, if you take a loan out from a commercial lender, on your profit and loss account, you will see interest paid, and that interest will reduce your sales to come to net profit, on which you pay corporation tax. So it's a taxable expense, which will help you get more expenses into the business. On balance sheet, it will show you a short-term loan and long-term loan. So it will show you the total worth of your business and how much you owe to the people outside. And cash flow, obviously, it is a big effect on your cash flow, because your money is changing hand, and you need to make sure that you understand the cash flow implication of it. The tax implication, again, the loan repayment has no tax implication. So when you're paying the loan out, that's not an expense. It's simply money that you got is going back to your lenders. But the interest, as I mentioned, can be tax deductible. For investment purposes, profit and loss, again, there's no implication for the money that you're receiving. But when you pay out the money from your profit to your lenders or to yourself or your friends, the money is treated as dividends and is paid out after tax. So it's not a taxable expense. It goes after you have paid all of the taxes. Whatever the balance is left behind, that can be used as the dividends to be paid out to all the shareholders. The balance sheet shows the amount of value that have been put in by the shareholders. So it shows the value of your business and it increases the value. And again, the cash flow, when you receive the money, your cash flow increases. And when you're paying out dividends on a monthly basis or yearly basis, that is the cash flow going out. However, all of this information will be public to Companies House on how much your company is owned by shareholders. The tax implication is the investment received is a non-taxable item, and the investment, but individual are taxed on the income they receive from dividends. So if you're taking the money out, and your investors or your family friends they will be taxed on the money that they are taking out. So some actionable next steps: know your numbers. Start with budgeting, forecasting, and understanding your business. I've shared a small template for you. Again, that's a very generic template. You can mold it to your own needs. Analyze your current stage of your business and select appropriate funding for yourself. We talked about different options and see which is the best option for you. Understand how each option affects your business and the tax and accounting implication of all of those options, and will that benefit you in long term or not. Maintain a good bookkeeping. If you have the up-to-date bookkeeping, it helps you with budgeting. It helps you understand how the specific loan or investment you've made into a business will change the value of your business, and it helps you to plan and control. Because if you're doing daily bookkeeping or regular bookkeeping, you know exactly how much you're making, how much you're losing, and that helps you control the business. And understand how all of these options will only affect your business, but not you personally, because your limited company is separate to you, and anything that you do here is affecting your business, not you. Time for some Q&As.
Well, I've been interrupting you throughout with questions, but two more for you here before we wrap up the session. One is around crowdfunding, which you sort of, I think, touched upon sort of briefly. Are there particular types of businesses that you think are particularly suited to crowdfunding? Because I imagine it's not going to work for everyone.
No, definitely not. Look, if you're a small business and you're growing quite rapidly, and the idea that you have or the product you have is doing great, and if it's generating enough cash flow for yourself, then for you a better option would be to look at lenders and try to see how you can. So rather than giving out a part of your business, it's better to see if you have different options. Going public and investors, they're normally startups with big investment pool already in the bank, and then they're going public to get more investment and grow into millions of revenue. It's probably more relevant to them, and even the public themselves will only invest in a company which has a future growth prospect, but not something which is done on personal basis on individuals. So yeah, and again, you need to convince the public that you will be making a lot of money out of the business, and then only they will invest into you.
So growth potential absolutely critical if you're going to go out to sort of crowdsource your funding. At the start of the presentation, you were sort of talking about the sort of the budgeting process and the sort of critical importance of that to drive cash flow forecasting and build sort of investor confidence. I imagine you've looked at an awful lot of draft budgets over the years from different clients. Without giving any sort of names away, have you ever looked at a budget and gone, oh my goodness, this is a mad way of spending your investments, and sort of got your red pen out and started putting lines through? What do you think of the sort of alarm bells for where you probably shouldn't be spending too much money when you start out?
Well, yes, I definitely have gone through a lot of budgets myself. One of the key areas that I've seen a trend or a common way that people do tend to think is when they're budgeting sales. Your product can be a great product and the idea could be one of the best, but to budget that you will start making sales from day one is a bit of a concerning area, because there are so many things that can go wrong, and especially the marketing tools cannot be in right place. Marketing expense. I've seen initial investors who received a good investment from angel investors or something. They have a really big focus on their marketing expense. So a big or red circle always goes through the marketing expense. So there is a trend, but once you have spent few months, you started to understand that the marketing is related to your sales. And if it's not bringing, so each pound spent on marketing should bring you a certain number of sales. And if it doesn't work,
So,
then
so,
you
so you're looking for marketing money to be spent wisely rather than frittered away indiscriminately,
exactly.
not delivering impact. We've had two more questions to come in. One is from Nicole Bridges. She's sort of pushing us a bit more on crowdfunding. So wondering whether it sort of perhaps appeals more in the sort of creative sector, and whether it sort of perhaps plays. Historically perhaps more in a B2C environment, but she says, are there any particular crowdfunding platforms that you think can work for more B2B focused businesses?
So there are a lot of agents out there, and aggregators out there, that can help you. And yes, so if you don't want to go public, like just go to the listing, you can actually go to these pool of investors who can look at your business idea, and then they then pitch to them, and then they decide how much they want to get into it. So there is a whole system and ecosystem out there where there are let's say thousands of investors sitting in one ecosystem and trying to find out which business to invest into, and you can go to them and get your investment from those individuals.
So lower profile routes that may be better suited to the B2B propositions. And then from Paulina. Brown has asked what I think is our final question of the morning, and that's whether you can expand a little bit more on the sort of current landscape for business support from government. Have all of the kind of grant schemes around COVID that we've seen over the past 18 months, have they all come to an end?
Almost. So there was the furlough scheme, the SEIS scheme, it had its last stage as well. All of the reliefs have been almost at a stop as well. So as far as I know, all the clients that are relevant to me, we don't have any more COVID funds for them. But I can look into it more detail, see if there's anything still left out there. But regardless of COVID as well, there are many other grants that are not very publicly known. So the one that I mentioned, the startup loan, which gives you £25,000. I spoke to my current clients, none of them knew about this. So it's always worth to check what options available are out there for your specific type of business.
And I think on some of your other sort of webcasts, Taimur, you've sort of gotten into the nitty gritty of things like R&D tax credits, which again is sort of government financing that's been around for a long time and isn't so COVID dependent. But certainly, I think at West London Business, our sort of perspective echoes yours that most of these the COVID grants are sort of tailing off, and I think sort of probably March of next year is when the sort of remaining schemes that some of the local authorities are administering will come to their end. Now I'm going to be flexible here because we've had two more questions that have come in. So rather than wrapping up straight away, I'm going to give these an airing, and I'm going to go to Emily Thompson's question. Which is of all the short-term borrowing methods sort of discussed today, is there any sort of particular pattern that you're seeing at Osome over which is the most popular or preferred? Because it was a long list of different options that you went through. What's top of the charts?
Overdraft is one of the most common ones. People tend to get and overdrafts interest rates are slightly favorable because they have been pre-approved, and the cash flow is very up and running because any money you receive goes to overdraft first before it actually hits your positive figures. So banks do not charge that much on it. So overdraft is the most common one. Working capital loan is the next one because a lot of our clients buys and sell goods on their e-commerce platforms. So we have companies, partners who specifically focus on working capitals, and so those are the two most common ones. But I have seen companies, I have a client who's a game producer, and I've seen them borrowing from friends and family as well. Startup is mainly friends and family.
That's yeah, interesting to know, but I think sort of triangulates well against what we've picked up at WLB. Last question, it really is the last question of the morning now, from Stacey Kalmari, who wonders, beside the sort of longer repayment time on a long-term loan, are there any hidden pitfalls of a long-term loan versus the short-term?
No. So the long-term loan, like if you talk about from accounting perspective, long-term loan just shows an outstanding balance for longer on your balance sheet, which means that the more time you take to pay, it will linger on your balance sheet. And if you go to an external investor or something else, they will always see that balance there. And again, long-term loan always have higher interest rates. But apart from that, the conditions are same. There shouldn't be any hidden pitfalls comparing the two.
Goodness, we've covered a huge amount of ground in just 50 minutes, Taimur. It's been a whistle-stop tour of the world of financing our businesses, and I think hopefully something for everyone there, whether you're sort of coming at this topic for the first time or whether perhaps it's a bit more of a refresher. So thank you again. Great to be in conversation with you, and just to say to everyone tuned in, have a great rest of your day. Thank you for joining us.
Thank you, everyone. Thank you.